Hello everyone, welcome again. This is Hybrid Financial Consultants, as you see here, and this is my WhatsApp number. You can check me directly for anything that you need concerning academics or accounting. And today we're just going to take a look on a new subject called accounting cycle. Actually, accounting cycle is the basis for accounting, financial accounting, financial reporting, up to corporate reporting. All that encompass. Accounting cycle encompasses all that. So we'll see one at a time, and we'll just try to see the sequence of the accounting cycle. But in later stages, I'll just go one point after another, learning about each and every part of the sequence. So before starting with that topic, if you are the first to come to this channel, you should know that we're providing the following courses: financial accounting, financial reporting, cost and management accounting, then quantitative techniques, performance management, financial management, as well as Microsoft Excel. Subscribe to help grow the community, or check me through this WhatsApp number. Now let's go to our topic, the accounting cycle. What is the accounting cycle? Actually, it is simply a sequence in which data is recorded. Accounting data is recorded and processed until it finally forms part of the financial statements at the end of the reporting period. The main aim of preparation of the main aim of the accounting cycle is actually to for accountants to prepare financial statements, because when conducting business transactions, we'll be having invoices, receipts. So converting those receipts, invoices, and other source documents to financial statements, in that process, the accounting cycle is involved. So simply speaking, the accounting cycle has the following sequence. First of all, source documents, like I've said, invoices are source documents, but also books of prime entry. We'll see them later. And then we have ledgers. Then after ledgers, we have trial balance, and lastly, we have financial statements. So you have to know the interconnection between these 5 parts of the sequence. So listen carefully. We'll just go in brief, and then in other videos we'll explain one sequence after another, one part of the sequence after another. So starting with source documents. What are source documents? As I said, the great examples of source documents are like sales and purchases, invoices. You could have debit notes, credit notes, something like that. When a business transaction takes place, for example, you sold goods to a credit customer, you can send them the sales invoice, and that invoice can be used to make double entry. If you have ever made something like double entry, let's say I have debit trade receivables, that means that the customer owes me and I've credited sales, something like that. So before going to double entries and all that, we start with source documents. So an example of source documents could be sales or purchases invoice. We could have debit and credit notes. Actually, we'll see debit and credit notes, what they mean. Actually, they are also source documents, but they arise when, say, you have sold goods to a customer and the customer has returned them, or you have purchased goods from the supplier and you have returned back the goods. Maybe let's say they are provided above what you needed, or maybe there could be another reason, say the goods are faulty, so things like that. So this is another example of source document. Then you have books of primary entry. These books of primary entry have other names. What is the other name of books of primary entry? Who could help us? Actually, the other name for books of primary entry, you can just call them books of original entry. Books of original entry. Instead of prime entry, you could say original entry. Things like this. Or sometimes they are just referred to as journals. This is another reference. So if you find the term journals, just the same thing. So these are books of primary entry, as I've said here. The books of primary entry, and it is where the original information is initially recorded. So, for example, as I had sold goods to a credit customer for $500, there will be a book concerning this credit sales, and then I'll just go there and record $500 in that book. So simply speaking, there are several books of primary entry, at which point we will see the individual as well as total of items. We'll just see a little scenario here. So simply speaking, what are the books of primary entry? The books of primary entry include a lot. We can have sales day book, purchases day book, returns inwards day book, but also you could have returns outwards day book, cash book, petty cash book, and the general journal. So there are several classes, and each of which incorporates a certain criteria. For example, if you say sales day book, this is the book that records credit sales of goods to customers. While purchases day book records credit purchases of goods from suppliers, the sales or purchases must be on credit, and they should be concerned with the goods, not anything else, just goods. So you have to know that. And here you have returns inward day book. By returns inward day book, it only means that you have sold goods to a customer, and the customer has in turn returned the goods. So that one you call returns inward day book or sales returns day book. Then you have returns outward day book. You have purchased goods to a supplier, but you have returned some goods, maybe they are faulty, something like that. And so these documents, debit and credit notes, are used for returns inwards and returns outwards day books. But also for sales day book, you could use sales invoices. For purchases day book, you could use purchases invoices, things like that. And then we have cash book. Cash book records all transactions for cash, all cash transactions, everything involving cash. Transactions involving cash are recorded in the cash book. And then we have the petty cash book. Actually, by petty cash book, what we really mean is that is a company. There are sometimes sundry items, a little item that occur frequently, but they are of little value. So a certain amount can be set aside just for that task. So you can have a petty cash book. Actually, we'll just see the petty cash book in its own video. It incorporates things like a reimbursement. Let's say you need a certain amount at the start of each month, and at the end of the month, you just check the amount that has been used. You just add it up there, and then you proceed. And then you could have the general journal. General journal records everything that was not recorded in these books previously. Anything that was not included in the books here is recorded in the general journal. It is sometimes common to refer to just a journal, but actually it's a general journal because all of these are journals, can also be referred to as journals. So let's go to number 3, which is ledgers. So when reaching ledgers, by reaching ledgers, just before going to ledgers, I could show one example here. Actually, let me show one day book to give you a proper grasp of what I was speaking about. Let's imagine we have a sales day book here. This is your sales day book. So in your sales day book, let's just presume maybe you could have a date. Maybe this is the date. Maybe this is the invoice number, sales invoice. Actually, you could have a customer. Maybe this is the customer. This is your customer, and then it can be the amount. Let's say the amount in dollars that will fall to a customer. Let's say this is the date of 1st January 2008, for example. This is just an example. It's very, very important to be careful when we look at what I'm just going to show here. Let's say this is the date, 1st January 2008, and you have an invoice number. You can just write anything. Let's say ACCA 12. Let's take an example. And then maybe I fall to customer called John. And then maybe I sold goods worth $300. And let's presume we have the second customer. Maybe we sold goods on 6th of February 2008, the same year. And the invoice number, let's say, was AC17. Let's presume, or AC13. This is just an example. Maybe I sold to another person. I sold to Mary. Let's say I sold to Mary. So if I sold to Mary, let's say the amount was 500. What would be the total amount here? If you come here and compute the total, 300 plus 500, you get 800. 800, so this is the total. So this is the sales table. Now you have to understand one thing. When preparing ledgers, as I have shown down there in the next slide, when speaking of ledgers, we have three ledgers. You could have the general ledger. You could have the sales ledger, and also you could have the purchases ledger. If you understand the things, purchase ledger. So you have only three types of ledgers. Now, what of all the three? We just have three types of ledgers. You have to understand one thing. When going to ledgers, from ledgers, it's where double entry starts its action. Double entry starts the action, but also there are some ledgers that can just be used as a memorandum just for memory purposes. But actually, it won't be like this. So, if you have a general ledger here, and here you have the sales ledger, and here you have the purchases ledger. So, for example, this is a general ledger. You just take the total amount. Total amount is 800. So in the general ledger, you just have to understand one thing. This is the sales ledger. The sales ledger will incorporate several accounts. Will incorporate the account for John, but also will incorporate the account not just for John, the account for Mary. So for John, it will show 300, as you see there at the top, and for Mary, it will show 500. But in the general ledger here, there is a sales ledger control account. So not one thing. You can have a sales ledger, but also you can have a sales ledger control account. So as far as the general ledger is concerned, instead of taking 300 and 500 separately, you just come here to the sales ledger, just like this. This is a sales ledger. We just take the total for John and Mary, that is 800. 800. Think like this. So you have to be very careful when dealing with this. So this 800 will be for the sales ledger control account. Sales ledger control account. When speaking of the control account incorporates everything in total. So instead of taking 300 and 500, it just takes directly 800. So that's why you have to understand that unless otherwise stated in an exam, we presume that double entry is made using the general ledger, not the sales ledger. The sales ledger shows separate accounts for each customer, for each credit customer. While in the general ledger, we have the sales ledger control account, which shows the total values in total, not just single point, values in total. So you have to be very careful so as to understand well what I'm speaking about over here. So something like this. So, for example, here, let's presume we are just trying to make the double entry. You have sold goods to a customer on credit, so you debit trade receivables by 800 directly, not 300 and then 500. By this, we have sold, so we're able to credit sales. So we'll credit sales. I'll credit sales by 800, something like this. But note that all this total sales figure, this 800 here, came from this point in the sales table. You have to understand this very carefully because it will help you immensely when dealing with correction of errors and suspense accounts. It came from this point, not from this one, but at the same time, we transferred 300 and the 500 to the sales ledger. So you have to understand one thing. When the company is holding both the sales ledger and the sales ledger control account, all of them, just one is used for double entry. Only one is used for double entry, and the other is just for memorandum purposes. It has nothing to do with the double entry. I hope we understand each other. So it's just like this. So generally, the general ledger is used for double entry, and the sales ledger is just used for memorandum purpose, unless otherwise clearly stated in an exam. If an exam states that the company does not hold the sales ledger control account, that means it only holds the sales ledger, and so the sales ledger is concerned with the double entry. I hope you are together. I just wanted to clarify this before proceeding to other chapters. Thank you. So we can proceed there. So we have our ledgers. As I've said, ledgers are just summarizing individual transactions present in the books of primary entry. Double entry is used, but also I've spoken of memorandum. And the ledgers can be general ledger, sales ledger, as well as purchases ledger. Then we have the trial balance. So after that, the trial balance is just a summary of the ledgers that were used for double entry. So it is a summary of all account balances, and the total of debit and credit side should be equal. Actually, it incorporates those accounts that were used for double entry, not memorandum accounts, just the accounts for double entry. So you have to note one thing. After preparing the trial balance, you have to check if there are errors. There are errors which will make the trial balance fail to balance, but also there are errors which will not prevent the trial balance from balancing. The trial balance will balance, but actually there will be a problem. So you have to check the errors. That's a very different topic, which I see too. And lastly, you have the financial statements. That's our main goal. So these are the primary intention of the whole accounting cycle. The whole accounting cycle, they are just to help us prepare the financial statements. Also, the year-end adjustment like depreciation allowance for doubtful debts and their accruals are considered. What do I mean by this? When preparing the financial statements, you have the trial balance that will incorporate the balances at the beginning of the period and what transpired during the period. But also at the end of the year, you have to understand additional information. So adding to the trial balance, we also check the additional information at the end of the year so as to use them to adjust the trial balance and thus be able to prepare the financial statements. That's why I've said here, things like depreciation. You check depreciation, you expense it, you reduce the value of the asset. Allowance for doubtful debts, this will affect trade receivables or debtors, and accruals. Accruals are also considered. There is actually a lecture on accruals and prepayments. You could just check the channel and watch it. But actually, when speaking of accruals, it's just let's say that you're just preparing the financial statements and you had to pay rent of $8 million. But at the end of the year, you had just paid $7 million. That means you still owe $1 million, and that would be a liability, an accrued expense. So these are the components or sets of financial statement. First of all, have an income statement, or also known as statement of comprehensive income, or statement of profit or loss and other comprehensive income, something like this. This shows the performance of the entity for a given period. And then you have the balance sheet or statement of financial position. It shows the position of the entity, the wealth of the entity at a certain point, its assets, its resources, its obligation, as well as its equity. And then you have the statement of cash flows. Is you know that the statement of profit or loss is usually the income statement is usually prepared on an accrual basis. So being prepared on an accrual basis, you could have a poor picture about the profit. We could be deceived by the profit. The profit could seem very large, but actually could have generated very little cash. Maybe a lot of sales are made on credit. Maybe we made a lot of investments, so we could have a little cash. And so after this, we go to the statement of changes in equity. Equity equals to assets minus liability. So that we'll need to know how did the equity change from the start of the period to the end of the period. And then you have notes. These notes just give detailed explanation of what is recorded in the financial statement, maybe depreciation methods used, useful lives used to determine depreciation. Maybe you could have a figure aggregated. Let's say you have a cost of sales equals to $70 million. How could you know how it was arrived at? You could just go to the note responsible for cost of sales and learn everything. And so the next videos explain each sequence of the accounting cycle from the source documents, then books of prime entry, and then ledgers, and then our trial balance, and lastly financial statements as well as adjustments. So thank you very much for watching this video. Subscribe to help grow the community, and also you could share to others. Thank you very much, and until next time. Until next time.